Chapter 11. Financial Market. Question 7. Answer the following. 8 marks each. 1. Explain the functions of financial market. Answer. Financial market is a market where buying and selling of financial assets, that is financial instruments, take place. It serves as an intermediary between investors and borrowers by mobilizing savings and converting it into investments. Following are the functions of financial market. 1. Transfer of resources. Financial market basically facilitate transfer of real economic resources from the savers to the entrepreneurs who need funds. 2. Productive usage. Financial market facilitates productive use of the idle funds. It acts as a link between the savers and investors. It transfers the money or capital from those who have surplus money to those who are in need of investment for productive usage. 3. Enhancing income. Financial market enables lenders to earn interest or dividend on their surplus funds which otherwise remain idle with them. This leads to enhancement of individual and national income. 4. Capital formation. Financial market transfers savings of savers to most appropriate investment opportunities in industrial and commercial organizations. This facilitates capital formation in the economy. 5. Price determination. The demand and supply of financial assets and securities in financial market helps in deciding the prices of various financial instruments. The investors are the suppliers of the funds, and the business organizations are the users of the funds. The interaction between the two determine the prices of financial instruments. 6. Sale mechanism. Financial market offers the benefit of marketability and liquidity of financial assets of investors by providing them platform to sell their financial assets at the best possible price. 7. Mobilizing funds. Financial market acts as a link between the investors and corporates. It links the investors having surplus funds with corporates that require investment. This enables investors to invest their idle savings as per their choices and risk assessment. Thus, idle funds in the economy are mobilized through financial market. 8. Liquidity. Financial market not only provides mechanism for selling, but also provides mechanism for liquidating the financial instruments of the investors. The investors can convert their financial instruments into cash at any given time by selling through financial market. This is beneficial to those investors who do not want to invest for a long period. 9. Easy access. Financial markets are readily available anytime for both the investors and the borrowers. They provide a platform through which investors and corporates can find each other easily. 10. Industrial development. There is a strong positive relationship between financial market and industrial development. It helps in converting savings into capital. It enables the corporates to use the idle funds of investors for undertaking productive activities. This leads to economic development. 2. State the instruments in money market. Answer. Money market is a market where lending and borrowing of funds take place for a short-term period, varying from 1 day to 1 year. Only those financial instruments are traded in money market which are immediate substitute for money. Following are some of these financial instruments. 1. Call money and notice money. When the funds are lent or borrowed for a very short period, that is 1 day, it is called as call money. When the funds are lent or borrowed for periods between 2 days to 14 days, it is called as notice money. Here, the borrower has to repay the funds to the lender within a specified time on receipt of notice from the latter. Call money and notice money market is also called as interbank market, as it facilitates a bank facing temporary shortage of cash to borrow funds from another bank with surplus cash. 2. Treasury bills, T-bills. T-bills are the short-term securities issued by RBI on behalf of the central government to meet the short-term funds requirement of the government. T-bills have short-term maturities with highest up to 1 year. Currently, T-bills are issued with 3 different maturity periods, which are 91 days, 182 days, and 364 days. T-bills are negotiable instruments and are freely transferable. T-bills are issued for a minimum value of rupees 25,000 and thereafter in multiples of rupees 25,000. They are issued at a discount to the face value. At maturity, the investor gets the face value amount. The difference between the discounted value and face value is the return earned by the investor. Therefore, they are also called as zero-coupon bonds. T-bills are purchased by individuals, banks, firms, institutions, etc. 3. Trade bills or commercial bills. Bills of exchange are negotiable instruments drawn by the seller, drawer, on the buyer, drawee, for the value of the goods delivered to him. Such bills are called trade bills. Generally, trade bills have maturity period of 90 days and are easily transferable. In case the seller wants immediate cash, he can discount the trade bills with commercial banks. When trade bills are accepted by commercial banks, they are called commercial bills. The bank can rediscount these bills any number of times till the maturity of the bill to meet the short-term liquidity requirements. 4. Commercial papers, CPs. Commercial paper, CP, is the short-term, unsecured promissory note issued by large corporates, financial institutions like SYJC-SP, Exim Bank, etc., and primary dealers, with a fixed maturity period varying from 7 days to 1 year. These corporates and financial institutions have a high credit rating, due to which CPs are unsecured, with companies' credibility acting as security. The minimum face value of CP is rupees 5 lakhs, and thereafter, in multiples of rupees 5 lakhs. It is issued at a discount to the face value. CPs offer relatively higher returns compared to normal bank deposits. Usually, individuals, banks, mutual funds, companies, etc. invest in CPs. 5. Certificate of Deposit, CDs. CDs are unsecured negotiable promissory notes issued by commercial banks and financial institutions. It is a receipt for funds deposited in a bank for a specific period at a specified rate of interest. The primary difference between a CD and a fixed deposit is the principal amount that can be invested. CDs are issued for a minimum of rupees 1 lakh or in multiples of rupees 1 lakh thereafter. CDs can be issued at a discount to the face value. The maturity period of CDs ranges from 7 days to 1 year if issued by banks. Other financial institutions can issue a CD with maturity ranging from 1 year to 3 years. Individuals, companies, etc. invest in CDs. However, because of the restriction on minimum investment amount, CDs are more popular among companies. 6. Government securities. The marketable debts issued by the government or by semi-government bodies which represent claims on the government is known as government securities. Government securities are issued by central government, state government, local bodies such as municipal corporations, etc. These securities are very safe to invest, as payment of interest and repayment of principal amount are guaranteed by the government. These government securities are in the form of stock certificates, promissory notes, and bearer bonds. 7. Repo or repurchase agreement. Repurchase agreements are a formal agreement between two parties, where one party, who needs money, sells a security to another, with the promise of buying it back, at a higher price, at a later date, from the buyer. Repo rate is the rate at which banks can borrow from RBI, and reverse repo rate is the rate at which RBI borrows from banks. This agreement is usually made between RBI and commercial banks. RBI uses this agreement to control the money supply in the economy. Of all the money market instruments, repurchase agreements are the most liquid, having maturity ranging from 24 hours to several months. 8. Money market mutual funds, MMFs. A money market mutual fund is a mutual fund that invests solely in money market instruments like call money, repos, T-bills, CDs, etc. Money market instruments are forms of debt that mature in less than 1 year and are very liquid. Money market funds are generally the safest and most secure of mutual fund investments. Individuals and corporates invest in MMFs. 3. State the features of capital market. Answer. Capital market is a market for borrowing and lending long-term financial securities and instruments. It is a market where financial assets having long or indefinite maturity period, like stocks, bonds, etc., are dealt with. Following are the features of capital market. 1. Link between investors and borrowers. Capital market is a crucial link between saving and investment process. It transfers money from savers to entrepreneurial borrowers. 2. Deals in medium and long-term investment. Capital market provides funds for medium and long term. It does not deal with channelizing saving for less than 1 year. It enables corporates and financial institutions to access long-term funds from domestic as well as foreign markets. 3. Presence of intermediaries. Capital market makes use of different intermediaries, such as brokers, underwriters, merchant bankers, collection bankers, depositories, etc. These intermediaries act as working organs of capital market and are very important elements of capital market. 4. Promotes capital formation. The activities of capital market determine the rate of capital formation in an economy. It offers attractive opportunities to those who have surplus funds to invest more and more in capital market. 5. Government rules and regulations. The capital market operates freely, but under the guidance of government policies. These markets function within the framework of government rules and regulations. For example, stock exchange works under the regulations of SEBI. 6. Deals in marketable and non-marketable securities. Marketable securities are those securities which can be transferred. Marketable securities are those securities which can be transferred. 7. Variety of investors. The investors in the capital market comprise of individuals, like general public, and institutional investors, like mutual funds, insurance companies, financial institutions, etc. Therefore, it consists of wide variety of investors. 8. Risk. The financial instruments dealt with in capital market have a very long or indefinite maturity periods. Therefore, the risk is very high. However, the return on investment is also very high.